Well, good afternoon. Good afternoon and welcome. Welcome to another of our webinar Wednesdays. Good afternoon. I'm Kelly Bearden. I'm the director of the CSU Bakersfield Small Business Development Center. Got a great program today. Taxes. Boy, I'll tell you, taxes and the PPP. How can you go wrong? Something that we've been wanting to address all year and still maybe don't have enough information, but we're going to do our best today. So, a little bit about us at the SBDC and what we're doing here is our 40th consecutive Wednesday of Managing Your Business Through the Pandemic webinar. And we're part of America's SBDC. It's a program in all 50 states, as you may be aware of. We are part of the Central California region, which goes to the top of Mono County, down to Kern County, to the Pacific Ocean in the state of Nevada. We serve all of Kern, Inyo, and Mono counties, territory roughly larger than 7 or 8 U.S. states. And thank goodness for these type of technologies, which have really helped us in eastern Kern, Inyo, and Mono counties for a number of years now. So glad to have the technology, glad getting great use out of it, and great to be doing these webinars today. So, a little bit about what's up today, and we're up to December 16th. There's more news on stimulus. I know we've been talking about it since July, the new stimulus deal, but the more I try not to talk about it, the more they seem destined to try to get a deal done. And we'll talk a little bit about it, the latest of as of this morning. Talk a couple more tips on PPP forgiveness. We'll give kind of an update on what's going on, of course, with testing and cases and reclosing. Going soon is going to be our EIDL, our economic injury disaster loans. They end the 31st. It's not too late. The platform will remain open until I believe the 31st. So if you change your mind or if you want to sign up for and try to get the EIDL loan, remember, not quite as easy as the PPP. There is an underwriting process involved. You repay it 30 years, 3.75%. Great program, going fast. So also another outstanding program we've had great mileage from, and that is the Kern Recovers PPE that has supplied all types of personal protection equipment across Kern County. My knowledge of it's running until the 31st also, so you can go to the Kern Recovers website and you can download the form and order a number of different personal protection equipment, such as wipes and sanitizer, mask, and gloves. Also, the Main Street Lending Program will be ending up at the end of this month. And again, not really a lot that we've seen done in the San Joaquin Valley out of the Main Street Lending Program, but still it was a tool, and maybe it'll be back next year. We'll wait and see. Kind of bigger deals on that program, but if you have something you want to get done, now's the time to get it done, because it could be gone forever as of December 31st. Got a couple great special guests, Lou Barbich and Patrick Hoffman, who I'll introduce in a little bit. And we'll get into a lot of your tax questions today, a lot of the things that are hanging out there with these wonderful programs that we have, but still just not quite all the answers on them. So your questions today, put in the Q&A box, and show up to the Q&A box early and show up often. Now's your time to get your questions answered. And we're going to have our poll question of the week. But before, normally I'll slide into the poll right here. I want to kind of preface a little bit what's going on with stimulus before we jump into our poll question. So when you look at the program that we had that came out as of December 1st, a bipartisan look of the problem solvers, we've only seen two things that have really changed from it that they've really noticeably talked about. And the two things in the bottom in red are the two items that have really been very tough to negotiate over the last 5 months of negotiations for the next stimulus package. So we're looking at the $160 billion for state, local, and tribal governments that'll probably be decided next year under a new administration and a new Congress. So that is something that's being talked about as being on hold and being not a deal breaker in this particular stimulus. And also with that goes away the short-term protection from any COVID-related lawsuits, which the Republicans were having a problem with the state local government funding. The Democrats having a problem with the COVID related lawsuits. So throw those two out. And the talk is hopefully they can get past a deal. Now, this morning kind of emerged new topics, and that one is a number two at the top, right under the 288 billion for small business support, and that is for individual stimulus checks. So this was about $750 billion when you take out the money for state and local, and we're looking at about half of the support that we had, roughly half of the support that we had in PPP. And also, we don't know how many, but how much, but it looks like individual stimulus checks are coming back as part of this deal. So really the key for this thing is going to be the next 24 hours or so, 48 hours, when the refunding measure for the federal government to stay in business has to be approved. And it's likely that this could be done about the same time as that. So there you go. That's the latest. So now that we have the latest on that, now that we've kind of prefaced that a little bit, let's go into our polling questions. And we're going to talk, our first poll question is going to be a little bit about a second PPP if available. And I'm going to launch that poll right now, which is going to be a two-part question. And a current idea is to make a second PPP available to businesses that have suffered a minimum of 30% revenue drop in any quarter of 2020 on a comparable basis to 2019. Based on that, would you qualify? And the answer, the big question there is, have you had one quarter since April 1st? So, you have the second quarter, if you're on a calendar year, the third quarter, and now we're in the fourth. Have you had any of those to where you've sustained at least a 30% drop in revenue? Okay, a little bit different question. Never asked this one before. 30%, but that is what the criteria is going to be. Apparently, a lot to go on, a lot of negotiations, a lot of deciding between individual components of that. And we have about 46% of you that have voted right now. Again, we're looking to see if you have a 30% revenue or sales drop in any quarter on a basis from 2020 to 2019. Okay, we've got about a little over half of you, 55% of you have voted. Last chance to get in. Going to end this poll question. And you see number two right below it. If you've had that 30% drop, would you be interested in getting that second PPP? So a two-headed monster here. Have you had a 30% sales drop? If you have, would you seek the second PPP? Okay. We got 67% of you. I ended the poll. Let's share the results here. And yes, 55% of you have had a quarter that have had a 30% revenue drop. Hopefully we'll get some national news to compare that to see how regionally how we're doing and locally how we're doing compared to nationally. But 55%, I think that caught you a little bit, Luth, maybe a little larger than you thought. No is 32%, and maybe still under consideration is 13%. So it looks like if that's the criteria going forward, that 55% of you would qualify for a second PPP, not based on anything else. And of those of you that are in that group, 49% of you said yes. All but 4 of you say that you will go back and get another second shot of that PPP if that's what we get to see. Okay. Well, thanks for voting and for sharing. That's good information. I had to get a little bit fun with one of these questions, and so here goes. And I'm going to launch this poll, and it's about Bob Dylan, of all people. Bob Dylan made tax and estate planning news this week, and I figured with our CPAs on, what's a better time to ask this question? He sold his entire catalog of 600 songs recently. So roughly, how much did each song catch? How much did he get for each song? 600, there's a big total. So this is a roundabout way. 10,000, 60,000, 360,000, 600,000, or $1 million. Now, recall that a lot of people, a lot of artists are doing this now, selling it because of tax reasons and estate planning reasons. And artists, they make royalties on this. They've used it for albums and sold albums and gone to concerts. They've made a lot of revenue on these catalogs of songs. So 600, how much did Bob Dylan catch? Did he fetch? And with about 40% of you in, here's your last chance. A bunch of you are getting in now. And I'm going to stop it. Many of you might have heard that the entire catalog roughly caught around $350 million. So if it's 360 million, each song royalty was worth $600,000. Now, okay, now like great ones like a Rolling Stone. Okay, I can see that, but there's going to be some songs in there that out of 600 songs that are going to get that same value, $600,000. Okay, so there's the results for you, and just wanted to look at that. Of that, 41% of you, 60,000, 10 times that amount. 23% of you did get the $600,000 per song. Wow. Okay, so now moving along and there's our stimulus and such. So moving along let's talk about 3 quick tips, because I really don't want to take too much of your time today, but I want to give you a couple of quick tips on PPP while you're here. And actually, as soon as I am able to close my poll here. Okay. Sometimes you got to do it the old-fashioned way. And that's it right there. So, okay, going back, we have a number of PPP tips to go over real quickly. And the first one is going to be the length can be your friend. And essentially by that, what I'm saying is we've been giving you the timeline. And for 24 weeks, I want to just make this point. You have 24 weeks from the date of the proceeds were received by you. If it was on August 7th, then your 168 days runs till December 31st. Most of you got PPP before August 7th. With probably a majority of you probably by April or May. So you have 168 days from that time to spend your PPP allocation, and the 10-month window that you have then in order to file at the end of that. So if you did get your PPP funds on August 7th, you have till December 31st to spend those funds, and essentially then 10 months from the end of your covered period, which in this example is December 31st, or September 30th to actually file. Of which if you then go through the lender and SBA and they take a few months, you could be into 2022. So use that as your friend. Use the PPP timeline as your friend. And I know it's nice, and we're going to have some great reasons to get it off your books in a little bit, but remember that you do have time, and to not go by what it says on the form that it expires on December 31st. A lot of great tools out for substantiating your expenses and your other deductions. We're seeing a lot of the payroll vendors and now QuickBooks. I found out yesterday, thank you, Cheryl, that QuickBooks Payroll has actually got now a PPP format that you can actually use for forgiveness. So a lot of resources out there for that. And then really the heartache of the summer for PPP forgiveness has been these safe harbors. And so on safe harbors, it's really the safe harbors 1 and 2 are there for those that do not reach the PPP employment. And I just want to go over that one more time and to kind of share from an SBA workshop that they did. And I believe that's it right there, or not. Try a new share here. And so here we go, Fte reduction. And the thing I really want to focus on here is the words between March 1st, 2020 and December 31st. And if you were not able to receive that same business activity that you had at any time between that period, and essentially being shut down now, if your business is significantly impacted, this safe harbor is going to virtually be your get out of PPP jail card, so to speak, because it's going to really allow you to not have to look and calculate your reductions for forgiveness. So do keep in mind reduction number one, safe harbor number one, and safe harbor number two, especially since we've had this spike and so many more businesses are impacted. Now, if you were one of those businesses that did not have the 30% reduction in sales and have had strong sales, then it's going to be difficult using these. But for everybody else outside of that, you're going to have those two to really help you. And that's the 3 tips for today. There's our state programs that we've talked about. Maybe get into the hiring credits today and maybe sales tax deferrals coming after the first of the year. Keep coming back because we're going to be talking about the $25,000 grant for small businesses in the state of California that's going to happen sometime after the new year. And there are some progress. There have been some progress made toward that. And maybe we'll talk a little bit more about that next week. The California Rebuilding Fund is open and making loans, not forgivable, but they're making loans. And still have the franchise fee waived for those that are looking to change your ownership structure away from a sole proprietorship to some other legal form of business or entity. Free COVID testing with the Hispanics Chamber Task Force, the Latino Task Force, today at Virginia Park off of Mount Vernon on Virginia, tomorrow off of East Fairfield, so 2 East Bakersfield locations, and then McFarland and Shafter the rest of the week. Plenty of free testing. Other free testing sites you can get by going to this website through the County of Kern, of which many of those will qualify you. If you really need that incentive for that $25 gift card, you can get that too. Okay. Right now, it's a great privilege for me to introduce our 2 guest speakers today as I look to do a new share here. And our speakers today are Lou Barbich and Patrick Hoffman. They're both with the firm of, and Lou, I'm going to give you control, or Patrick, so you can kind of take it away. So I'll do my stop share, which is a double-sided sword for me because it takes away what I was going to read as far as your introduction. But I do know what you're both with Barbich, Hooper, King, Dill, and Hoffman off the top of my head. And CPAs, Lou has been around a number of years. Him and his wife Cheryl won the very coveted, you've heard me talk about it before, John Brock Award for community service to Kern County and the greater Bakersfield area. And so take it away, guys. I'm short on your intro today.
Kelly, that's great. Well, thank you. Thank you so much. Yeah, thanks for having us on. One of the things that, just this webinar showed is how many things you are imparting upon people, how much information you're imparting upon people to give us there's so many things going on. And you do such a great job of that. It's just amazing to me how you keep it all, but you work more than 8 hours a day on it, and so I really appreciate all of that. And having 40 seminars, there you are. That's better. I could see it. Anyway, having 40 seminars and putting all that on is a lot of work. But one of the things that Patrick and I are in the same office, but we're socially distanced. We're in our own office. Each of us are in our own office. And just introduce a little bit about Patrick. Patrick is the one that I always say he doesn't know anything else but Barbich, Hooper, King, Dill, Hoffman, because he came to work for us in February of 1997. He became a partner in December of 2010. So he's been there the whole time. He doesn't know any better or worse. He just knows our way of doing things, right, Patrick?
Yeah, and back then I had a full head of hair too. So working here for 23 years takes your hair away and turns your beard white. So,
Yeah.
but it's all been good. I can't complain. Quick
Yeah.
intro on Lou. Lou's my mentor. Like he said, I started here fresh out of Cal State Bakersfield. Cal State Bakersfield grad. Started here as an intern, worked my way up. But Lou's been a mentor of mine. I see his relationship with clients, gaining trust, and he's still doing it. I think he probably started before I was born. So
Yeah.
just trying to keep that flow going. So
Yeah. I always have a little joke about Adam and Eve and Luke came out about the same time.
but you can joke about that. I won't.
Yeah, there you go.
You.
There you go.
But appreciate the opportunity, Kelly. Also, we wanted to at least do a quick caveat. We always encourage anyone, we're going to give you the best information we have available currently. If you have questions, please bounce them off of your respective CPA or tax professional, or even your labor attorney, as a lot of these also impact labor. And if you're in the market looking for a CPA, look us up, look our website, give us a call, whatever you want to do. But at least wanted to throw out that caveat. We have some various things to talk about. I know Kelly already touched on the PPP, and we really don't have a lot of additional guidance currently. There is legislation being discussed to hopefully give us some more fine details and guidance, but currently as it stands, the IRS is not following the legislative intent of the CARES Act. So when you get a PPP loan forgiven, any of those expenses, you use that loan non-deductible currently. It's the same difference as being taxable income, forgiveness of debt. It's whatever expenses you paid with those funds are non-deductible. Now, the common question is, what if I don't know about my forgiveness by 12/31/2020? What if it trickles into 2021? The current guidance is that it should follow whenever those expenses were paid. So, it's on a cash basis format. So if you use those funds and paid those expenses in 2020, which most everyone did, the thought is if you later get that loan forgiven or partially forgiven, and it doesn't happen until 2021, there's still hindsight. So you have to categorize those expenses currently as not deductible in 2020, and you remove that loan from the books, even though you didn't get forgiveness till 2021. There's book and gap issues that are different as well. Formerly, California was different as well. They were going to treat it as forgiveness of debt income and not non-deductible expenses, but they have subsequently conformed to the federal rules. The issue right now is that if our government can get something passed to where they say those expenses are deductible, which was the intent, there's no guarantee that California will conform. So California is always a wild card. Normally they lean towards increased tax revenue and not necessarily giving you more benefits. So that is yet to be seen. They're discussing it in Washington now, so it's kind of a wait and see, and we're looking at it every day, trying to keep clients up to date on what's happening. So that's kind of a quick and dirty on PPP. I know there are going to be questions, and we might not get to those questions during this webinar, but we'll try our best. I think Lou's going to touch on what the government's currently talking about.
Thanks, Patrick. And they are hopefully currently talking about it right now. And there's two, they actually split the CARES Act 2 into two acts. The proposed federal bipartisan emergency COVID relief act of 2020 and the bipartisan state and local support and small business protection act of 2020. So they couldn't decide on the state and local income tax, state and local support, how much support they should get. And they couldn't decide on the liability protection portion, which is very important to all us businesses. So they pushed it down the road and they called it Protection Act of 2020, but I suspect that it's not going to happen until 2021. I think nothing else is probably going to happen in 20. But the first one, they are discussing right now, and it may be what we're seeing is it may be Friday when they hopefully pass it, and they added a $600 stimulus check to it, which placates some of the Democrats, and then also that's what our President Trump wanted to see also as a stimulus payment. So, support, but they still have support for state, local, and tribal governments of 160 billion. Unemployment assistance increase, that'd be 300. It used to be 600. Now they're dropping it to 300, but it's increased for 16 weeks, 16 more weeks until April. And so that would be very helpful. 300 billion added in PPP funds with the SBA. We talked about that earlier. We had, but you have to have a 30% reduction in your sales from last year, basically, to this year, from 19 to 20. And that's what I was surprised when we got the poll. That was a very good poll, Kelly, because I was surprised that it was actually that high, 55%. So there's a lot of people that are hurting out there. And so that's going to be very, very helpful. And I know people are waiting for that. Interesting enough, 55 will qualify and only 49 will apply, but I don't know what that means. So they don't want to fool with it. But then they allowed more expenses to increase supplier costs, facility modification expenses, and PPP to operate safely. So they've added more expenses so you could get a higher PPP amount. But the big one, make expenses paid with funds deductible. So make expenses paid with PPP funds deductible. That's consistent with the congressional intent included in the CARES Act. And like Patrick said, I think every seminar, I try to get on every national seminar that we can get on to get the latest opinion. And they're all saying this will pass. Let's hope it does pass. Then the second thing, if that does pass, it's going to help out a lot of employers that are people who have PPP funds for tax. We're doing tax planning right now, and it's really up in the air because we don't know whether those PPP funds are going to be taxable or not. So then the other aspect of it, like Patrick said, hopefully California will conform. The problem is California is looking for any revenue increase that they can. And I'm just afraid that then they're going to look at this as an opportunity to pick up a lot of revenue and a lot of taxes that they need to spend. Well, I don't know if they need to spend it, but they need it.
I think they need to spend it. So.
And then another one that's really good. It's very, very good. And I keep telling people that this may happen. I've been telling people this may happen is for any forgiveness under 150,000, it's going to be pretty much automatic. You have to certify that you have the backup on it. So anything under 150,000. So that'll be very helpful to a lot of people. I know some people are applying right now. And so let's wait for this to pass, and then they can do it a lot simpler. Couple more set aside funds for underserved communities, funding for mass practice. Let me see, U.S. Postal Service is going to get some money. Funding for, this is a good one, funding for testing and tracing, which is needed. And then funding for vaccine efforts. So let's just hope they pass it today or tomorrow. That'd be great.
Yeah, definitely. And so, yeah, that's the issue everyone's waiting to hear on. And the big deal about Friday is that this is all tied into keeping the government funded. So they have incentive to get something passed because they want to keep getting their paychecks. So got to keep government rolling. Kind of tying into the federal government too. I mean, for 2020, and some of this has been around already, but there has been some federal, payroll benefits, credits, et cetera. Wanted to point out a few items. One of them was, for employers, you could defer paying in the employer portion of the Social Security tax, the 6.2%, not the Medicare portion, but the employer portion. That was for wages paid, after March 27th until the end of the year. It is something that is claimed on your 941 quarterly filings, but it's a deferral. It's not a credit. It's not forgiving the payroll taxes. But if you do that, then it delays the payment of that employer portion. You can pay 50% of it by the end of 2021 and the other 50% by the end of 2022. So it's, for those that are having cash flow issues and concerns, it gives you some more time to pay those without penalties. All employers are eligible. Even if you got PPP loan forgiveness, you still qualify for that. Another thing I wanted to point out federally on the mandatory paid sick and family leave, not sure how many people are aware of this, but if you're an employer with less than 500 employees, and this has been out for a while, you're supposed to provide 80 hours of paid leave. And what qualifies that is if you have any employees that either have been quarantined with COVID or they've self-quarantined because they've had symptoms and they're seeking a medical diagnosis. If you have an employee like that, you're supposed to provide 80 hours of paid leave during 2020. That's paid at their regular rate, but it's up to a maximum of $511 per day. So keep that in mind. There's also a requirement if they're caring for someone with COVID at the home, normally with a child and they have school closures, there's also a requirement for that 80 hours as well. And that's paid at a 2/3 rate of their normal rate. And it's a maximum of $200 per day on that payment. If you do this and you pay this to your employees for those reasons, there is a refundable credit of 100% of those amounts paid. So you can get the full amount paid refunded as a credit. All employees count, whether they're part-time or new hires. And such payments, those payments that you pay, those leave, it's not subject to the employer portion of Social Security tax, kind of tied into the deferral as well. Small employers can claim an exemption. So if you're a small employer and you have less than 50 employees, and if the request was to pay this leave because they're caring for a child due to school closures, you can get an exemption. You have to demonstrate that you can't pay those amounts and it would jeopardize your business's ability to keep going as a going concern. So there are some requirements there, but wanted to point that out. And then finally, there's also an employee retention credit. That's a federal credit. You can claim up to a credit of 50% of wages paid to an employee, up to a maximum of 5,000 credits. So a maximum of 10,000 wages paid to each employee that you can claim a credit, the employee retention credit. So 5,000 credit per employee. This credit offsets payroll taxes. It's for wages paid after March 12th up till the end of this year. It's not wages that you paid for the leave that I mentioned before do not qualify for this credit. So you have to keep that in mind. And it's also not allowed if you got a PPP loan. So if you did receive a PPP loan, you cannot claim this credit. It is claimed on the 941, but it also, one of the qualifications for the employer, it's only qualified if the business operated during 2020 and they either fully or partially closed due to COVID, or they experienced a significant decline in revenue, which is defined as 50%. If you compared a current quarter versus a quarter in 2019, and it was 50% less, then that would also qualify you. It's not an and, it's an or. So you either fully or partially suspended operations, or you experienced a significant decline in revenue. So those are kind of the federal pieces of the equation that tie into this. I think, Lou, you're going to talk about the California small.
Question, Patrick. Yeah, on the deferral of employer payroll taxes, have you had many clients that have actually used that?
I personally have not, because it is a deferral, so you're going to still have to pay it, but I'm sure there's people that did take advantage of that.
Yeah, I only have one client that took advantage of it, and then they're wondering why they did, because it's coming up. Now it's coming up, they have to pay it, and of course payroll taxes need to be paid otherwise. So that was one. The other thing I wanted to mention is that there was talk that the employee retention credit was going to be that you could get a PPP loan and get the employer retention credit. I don't know if that's going to be in the law or not, but we need to look at it. They were talking about that though.
Yeah, correct.
So, California, Patrick, when did they come out with this small business hiring? Just recently, didn't they?
It was in October, but it goes back retroactive to January 1st.
Yeah, so it's a small business hiring credit. If you increase your hiring during the period of January 1, 20 and January 1, 21, that's the dates that you have to use for that. And the credit can be, the good thing is credit can be claimed against payroll, corporate taxes, personal income tax, and sales and use tax. So it's a refund. You'll get the credit back if you'll be paying in some money from that side. It qualifies as 100 or fewer employees as of December 31, 19. And this is the one kicker. You have to have a 50% reduction in gross receipts, determining by comparing the gross receipts from April to June 2020 with those April to June 2019. I don't know how many people. This is obviously targeted to those people that really got hit by COVID and the restaurants that had to shut down, those kinds of things. And it might be some other ones too that I'm not thinking about, but I think it. So a qualified employee is paid wages subject to withholding. The credit equals 1,000 for each net increase in qualified employees. So 1,000 for each qualified net increase. And and kind of interesting. He said, but the credit cannot exceed $100,000 for any qualified small business employer. Now, if you're under 100, how do you get even close to $100,000? I just don't understand that.
You can have 99 employees, so you can get $99,000.
Yeah, maybe 99. There you go. But that you have to increase. You'll have to increase.
You have to have a net increase. It's based on full-time equivalents. You got to, during that time frame, you got to show that you were able to ramp back up and rehire people. So
the application is open from December 1, 2020 to January 15, 21. So it's a short time frame. And the tentative, they're allocating $100 million for this credit. But Patrick, do you see a lot of people qualifying for this? I don't.
It's going to be a challenge to even do the math to figure out if you qualify, but the application period, and it is an application period, with the the California Department of Tax and Fee Administration, formerly the EDD. I think a lot of us still call it the EDD, even though they changed their name. But yeah, the application period is open now, December 1st until January 15th of 2021. So you do have to apply, but it is going to be, here it is, California gives you this credit, but you're going to have to jump through 12 hoops to qualify for it. So it's not a slam dunk to say, oh yeah, I qualify for that. I mean, there's going to be some analysis that has to go into it.
Yep. So I see that as fairly limited in my own, or with my clients anyway.
Yeah.
Patrick, you were going to cover.
Yeah. Yes. So, with the election that's going to be certified by the Electoral College, I think, I know there's differing opinions there, but wanted to talk a little bit about Biden's proposed tax policies that he shared. With the one qualifier here I want to mention is, it all depends on these Georgia runoff Senate elections. There's 2 election runoffs that won't even occur until January 5th. And I don't know if it's going to take them 3 months to validate the results or what's going to happen. But the challenge for us is that doing tax planning right now, and we've got 2 weeks left, not knowing whether the Democrats will have control of the Senate, that really impedes what can happen. So if Republicans win both those seats, then Biden can have all these policies that he wants to institute, but the likelihood of anything getting passed is probably going to be nil. I mean, they can fight it and just not approve it. But in that vein, still wanted to share what if some of his policies are, because it has impacted tax planning for some of our clients, which is a little different than normal. It's normally you want to get as much deductions as you can before the end of the year. You want to defer income. But now the thought is, well, if there's much higher tax rates coming in the future, maybe I want to recognize that income in 2020 instead. So some of his policies he's hoping for, with the TCJA, the individual tax rates were dropped, at least the top rate, down to 37%. He wants to increase that back up to 39.6, where it was beforehand. but it would only apply to any taxpayers making more than $400,000. The other big one is the federal capital gains rates. Capital gain tax rates are a lot lower than ordinary income rates. Depending on what tax bracket you're in, it can be as low as 0%. If you're in the lower tax brackets and you have a capital gain, it will be taxed at 0% for federal. California does not conform to any of this. But for federal purposes, at a high, if you're in the high income, a capital gain will be taxed at 20% and often have the 3.8% net investment income tax added to it. So the rule of thumb is usually 23.8. But Biden wants to take that top rate for capital gains up to 43.4, which the math on that is the top rate of 39.6 plus the 3.8 on top of that. So that's one of his wishes. You know, capital gain rates are no longer beneficial, and you'll pay 43.4 federal tax on that.
Patrick, would that be for, it's just taxpayers with taxable income of over $1 million?
Yes, correct. Yeah. So it's only if you have more than $1 million in income that you'll get that higher cap gain rate. That's a good point, Lou. Thank you. He also wants to increase FICA on wages in excess of 400,000. Another big target is the estate lifetime exclusion, which is currently at 11.58 million per person. There's discussion of wanting to drop that back down to 3 million per person or 1 million. So that has also caused, higher net worth individuals to start looking at, doing some year-end gifting, using up this 11.58 million exclusion while they have it, because there's no guarantee it's going to be around next year or going forward. It's an often common target on tax legislation that, hey, these high net worth individuals, we don't want you to be able to pass your assets down to the next generation without paying a 40% tax.
And Patrick, the strategy on that is, and it's already been approved, that if you use 7 million of your lifetime exclusion, they won't take that back away from you.
Correct.
If it drops to 3 million, you still got the 7 million, or you can do up to 11 million. So people are scrambling to do things, and there are ways that we found that you can, through a slat, it's a special type of thing where you actually give the assets to your wife in trust and in accounts, but that's always an iffy thing too.
Yeah. And looking at our time, I'm sorry, we're probably not going to get to questions. We still have more to cover, but a couple other items he had, increasing the child tax credit, from $2,000 per child to $8,000 per child, another $5,000 tax credit for anyone who's caring for another individual in their home, whether it's physical or cognitive needs, expanding the EITC, the earned income tax credit. He also wants to increase corporate rates from 21% up to 28%. And the thought is that would probably pass even, bipartisan. There's a commonality that they want to increase from 21 to 28% on corporations. And also another big target is he wants to eliminate 1031 exchanges. That's used a lot with a lot of our clients. If you're selling a piece of land and you want to diversify or expand into something else, oftentimes you use a 1031 exchange to not recognize that gain. He wants to get rid of 1031 exchanges. So that's kind of a quick and dirty on Biden's proposals.
Yeah, the other one that Patrick is the qualified income, the 20% deduction.
Oh yeah, Cuba.
Trying to eliminate that
for high income.
Everybody over 400,000. But the elimination of 1031 exchanges is really big, very, very big. The realtors are already accumulating all their funds to fight it, because this would be a real hurt.
Well, and there's concerns right now, because there's certain, you might have sold a property recently and you want a 1031. You've got, you got to wait till you close. You might not close on that new property until the following year. Will that be honored? There's still who knows? Hopefully so, since you already sold the initial property. But we did want to talk about year-end tax planning. Even though we don't have the ideal guidance that we would hope for, at least on the PPP loan forgiveness, but at least as you're evaluating, year-end tax planning, one thing, like I mentioned earlier, oftentimes if you can get away with it, you want to be a cash basis taxpayer, which means you recognize income when you collect it or deposit it, and you deduct expenses when you pay them, when you pay the cash for it. So oftentimes people would want to accelerate deductions in the current year and push off income to the following year. There's other people that are taking the opposite approach if higher income rates come next year. So just keep that in mind. But on the other side of that equation, if you're one of those small businesses that has been shut down or this year has been really rough and you've had, you're probably going to have an overall loss this year. Now, again, we're waiting on guidance on PPP loan forgiveness, which still would show that you're going to recognize that as taxable income because of not being allowed those deductions. If that happens, then you might still have taxable income, even though you don't on a cash flow basis. But if you didn't receive PPP money and you do have a loss, we wanted to at least stress that the CARES Act did extend and expand the use of net operating losses. So if you have an overall net loss, you can carry it back 5 years. So let's say the last 5 years, business was great, booming, and you had profits that you paid taxes on. If you incur a loss in 2020, you can carry that back 5 years and get those taxes refunded. Now, I want to stress this is federal only. California, of course, does not conform. And not only do they not conform, current California law is that they're not even allowing you to take an NOL deduction in 2020 through 2022. So you can't even take an NOL deduction for California purposes. So just keep in mind. Yeah,
Patrick, that loss, if it's for 2018 and 19, you can still carry it back?
For California, 18. They stopped it after 18.
18. No, I meant for the net operating.
Oh, yeah, sorry, for federal, yes. If those losses were incurred in 18, 19, or 20, you can carry those back.
Because we're going back and seeing,
yeah,
you can go back and actually pick up some refunds if they happen to have a loss in 18 or 19.
Yeah, the old law was you could carry it back 2 years. It changes almost every year, but it used to be carry back 2 years. You can only offset 80% of taxable income. So current federal law is you can carry back a loss from 18, 19, or 20 back 5 years. So that is an option. If 2020 ends up being pretty ugly from a tax perspective, at least you're not paying tax in 2020, but you can get prior taxes refunded.
Good point. Some common year-end tax planning techniques that we use all the time. Cash basis, you mentioned it. Cash basis taxpayers can prepay expenses before year-end and also defer income with deposits. Now, deferral of income, you cannot receive the check in 2020 and just hold on to the check. If you receive the check, it's constructive receipt, and you have to be picking that up in 2020. So it has to be deferral, and deferral done the right way with somebody doing it, so you don't get the check until the following year. And that's what they're doing. And we do have companies, the reason you might want to do that is do the opposite of what you normally do, is because the qualified income, the QBID deduction, the 20% deduction on business income, if that goes away, then your tax really changes significantly from 29.6 to 39.6. And so it can be quite substantial. So you want to try to do that. Another option is buying or putting in service equipment, autos, and we're doing that all the time. You look through, ask the client whether they really need some additional equipment, and if you can get it and place it in service before the end of the year. So you have to actually get it and place it in service before the end of the year. You could deduct it in 2020. So
yeah, and that's using the 100% bonus. And again, that's federal only. California doesn't conform. I mean, that's often the comment. Some of these federal tax maneuvers are not recognized by California. A couple other year-end tax planning things that I've seen clients use. If you have gains, capital gains from other sources, oftentimes you can evaluate your stock holdings. If you have a loss position, even though it's counterintuitive, I don't want to sell at the lowest end of the market, but you can sell, recognize that loss to help offset other capital gains. And then to avoid wash sale rules, which for federal purposes, you can sell that stock, recognize that loss, offset other gains, and you can rebuy that stock position, but you have to wait, more than 30 days to recognize that loss. So that's another planning technique near the end of the year. If you have other capital gain, you can evaluate stocks that you might have a loss position in, and there's plenty of those. A lot of oil gas stocks, a lot of those are in a loss position oftentimes. The other thing for 2022, if you have retirement income, IRA, et cetera, you can defer your RMD this year, your required minimum distribution. You don't have to take it in 2020, so you can make an election to defer that and push it off till next year. So that's another maneuver you have. I think, Lou, you're going to talk about the standard deduction.
Yeah, the standard deduction is now 24,800 for 2020. So the strategy is there, don't prepay your property taxes necessarily if you're already going to get the 24,800. So it won't do you any good because it has a maximum of taxes of $10,000. So what people have been doing strategy-wise is to lump them into 1 year, lump the property taxes into 1 year, and just to make sure you get over the $10,000. But the main one is contributions, is doing all your contributions in 1 year, and then the next year maybe not doing as much or relatively little, and then lumping them. So, but you can do that easily by 12/31/11. So the charity will not get hurt on that. The other one is the $1,200 stimulus payment. If you receive that payment, you need to report on your 2020 return that you received it. It's still not taxable, right?
Yeah, it's not taxable, but the stimulus payment was intended as like an advance on a credit. And so for those of you that might have had issues that, hey, I didn't get my $1,200 stimulus check, or maybe it was your adult child that you claimed in the prior year and then they ended up claiming themselves. On the 2020 tax filing, and we'll be asking our clients the same question, did you receive the $1,200 stimulus check? Because it needs to be reported on 2020 saying, yes, I did receive it. If you didn't, then you can claim that as a credit. So
as long as you're not over there's thresholds.
Yeah, there's all sorts of thresholds.
Thresholds that do that.
Yeah, they don't make anything simple. I guess it's job security for us. They keep it as convoluted as possible. Other thing, a couple other maneuvers. Also looking at selling appreciated property right now. If you're not going to do a 1031 exchange, while the preferential capital gain rates are still here, some people are looking at selling some property, and while those capital gain rates are already in effect and possibly going away, hopefully not. Another thing we mentioned earlier was evaluate, your estate lifetime exclusion. If you are high net worth, have a lot of value in assets, then evaluate those issues now. Hey, should I take advantage of my 11.58 million of gifting availability to shift that down to my kids or grandkids or whatever? Evaluate that. And then also you can always contribute to a standard IRA, and that you have until you file your tax return. So that doesn't have to happen by 12/31, but if you have taxable income and your income's low enough, that's also subject to income threshold. You can't deduct it if you're over a certain amount of income, but that's another, option you have until you file your tax return to have that tax benefit.
Hey, Kelly, we've got about 6 minutes to go on our regular. Do you want us to keep going, or do you want us to, the rest of it's just actually.
Yeah, I think real quick, Lou, the only important thing that you hear in the news often, we want to remind people, if you received unemployment, it is taxable. It's taxable for federal purposes, and oftentimes when you get that unemployment, if you don't tell them to withhold federal taxes, they won't. So some people are going to get a surprise on their 2020 tax return. If you received unemployment, for federal purposes, that is taxable. California does not tax it, but federal does. So just keep in mind, we don't want that to sneak up on somebody and they have they're getting their tax return done. They go, oh, I'm ready for my refund. And then that, jumps its ugly head up. Just a forewarning on that.
Kelly, what do you think? Go ahead.
I think he's muted.
I think it sounds great, and I think there's a lot of there's a lot of stuff that's still going to happen or not happen
Or not,
that makes so much of a difference.
yeah, the
So,
I was able to answer a few of those questions out there, but like I said, I mean, feel free to look us up on our website, send us emails. Always willing to talk to somebody that has a question. You know, that's how we meet people, get connections. We're always open for that.
and we do have some questions, and I'll start reeling them off, and we'll stay until they're answered. So if you got questions, you think of something else, jump in here. The first question we're going to ask is, if you get forgiveness for the first PPP, will it make a difference in obtaining a second one?
The way I've read it as it's being proposed and, you know, subject to change, the way I read it is that even if you got the first one forgiven, it will not forbid you from applying for a second.
That's correct. That's my understanding too, Kelly.
Excellent. Next question. I've been wanting to change banks, but I think I should wait until my forgiveness loan is processed. Is that a good strategy?
I think, I mean, if you want your bank to work with you willingly, it might be a smart decision.
Might be a smart, but they're supposed to, actually, they are required to process those. If they gave you the loan, they're required. And the banks, even if you're not with them, they want to get paid back by the SBA. So they're still going to encourage you to apply for forgiveness.
Yeah, and that's one thing I wanted to stress earlier that I forgot was, you know, we always encourage, even our own clients, when they're working through the forgiveness, we encourage them, you know, work directly with the lender as well. You know, they have each lender, each bank has their own different forms that they want you to complete, and hopefully they're working with you and being, you know, conducive to helping you out.
Yeah, one bank I've been working with, they have a whole team of people that just specialize in the forgiveness. So they're a great resource.
Okay, the next question is, an individual has a dispute about the covered period for their PPP loan. The bank told them it was from June 17th, but yet they didn't receive their funds until July 23rd. Well, I think there's an easy answer to that. I think if you go to your bank statement and you see when the funds were put into your bank, that your bank should be able to honor when the funds went into your bank and initiated your covered period.
Good answer. Good answer. Yeah.
So I think it's right there. You're dealing with your bank. It's on your bank statement. I would try them and then ask them why they have it 5 weeks different. Haven't heard that one before. Continuing along, will there be a recording of the webinar? We'll send some of the links that Lou and Patrick have talked about, and some of the things included in there will be a copy of today's webinar, or you can go to our YouTube channel, CSUB SBDC YouTube channel, which has our past webinars on it. Next question, the EIDL loan. If you applied and received funds but did not sign off on anything, is this the norm? And I'll jump into that one. Most likely what you received was the EIDL advance. If you just received something without signing anything, you've got the EIDL advance that if you did not receive a PPP, turned into a grant. Or if you received an extra EIDL loan, it doesn't matter. But it's on the PPP forgiveness process, you will be asked what EIDL advance you received, and you would need to then claim it there, as it will not be forgiven during your PPP loan forgiveness process.
They've already been doing that, Kelly, and they've been asking people, even if you got the full PPP forgiveness, to pay back that you can't get the full forgiveness. You have to pay back the EIDL grant.
Okay, next question. This is a good question. I haven't thought of this one, Lou and Patrick. Will the same tax treatment be afforded PPP funds be actually used by the Kern Recovers forgivable grants? So we have the PPP, but now we've had some local funds that are similar forgiven. Will they have pretty much the same, they have the same pool of money, the CARES Act? I'll leave that one to our experts.
Yeah. Patrick, that's all yours.
I knew you were going to pass the buck, Lou. You know, and I'll preface my comment with that I haven't delved deep into the Kern Recovers, you know, program, but if it's coming from the same pool of funds, I would hope common sense, and that's dangerous to assume common sense when it comes to this stuff. But if it's the same pool of funds, you would hope the same forgiveness rules would apply.
Yeah, we'll have to look at that.
Yeah, we'll have to look deeper to confirm that.
Yeah.
Yeah, we'll all look into that. I'll look in also to some of our lenders that did the Kern Recovers, and if we can't get an answer, we'll go to the county. And if everybody's not got an answer, then we'll keep looking. The next one is, what's the best way to apply for PPP2, and can you apply now?
Yeah, no, because it hasn't been it hasn't been put into effect. Right now, it's a current proposal that they're hoping will pass, but I'm sure we'll get guidance trickling in just like the first PPP. It'll change every day or every week, and we'll have to keep our eyes on it. But that's the current proposal, to be available, but it hasn't passed yet. So.
Knowing that, I think the lenders are already anticipating that it will be passed, that particular program will be passed at some time, whether it's tomorrow or in the next couple of weeks, but let's hope it's tomorrow.
And they've been through the process, so hopefully they're better prepared this time around. And yeah, they already have the mechanisms in place, so maybe they're, maybe in the background they're preparing for that and just waiting to get word whether it gets passed or not.
Yeah.
Okay, so next question. Patrick, you touched on the COVID sick leave of 80 hours for employees that were out under the FFCRA. I just wanted to confirm that if you received the PPP, but already used all your PPP funds, the employer is then allowed to use the FFCRA credit as long as they don't double dip that same period.
No, that is correct. I mean, there is a lot of these qualifications and the rules are they do not allow double dipping, just like we said, when you don't have to pay the employer portion, well, then you can't, get the other side of that. So that is correct. You can't double dip.
Okay, the next question is the county behind in processing Kern Recovers forgiveness applications. I don't know. I don't know if they're behind. I believe the process is that you still go through one of the local banks where you got the loan, and then they forwarded it over to the county. But we'll look into a little bit on Kern Recovers and have more on that on the webinar next week as far as how forgiveness goes. I have worked with, I don't know about you, Lou and Patrick, but I've worked with a few clients on the Kern Recovers forgiveness applications, and it seemed to be different dates that people were having to repay, or at least get the forgiveness applications in. So different timelines, but it seemed like everything was going along pretty well.
That's right. I get that from the person I live with, Cheryl. Cheryl's been helping the museum, and that seemed to be going quite well.
Yeah, my experience with a few clients that have applied for the forgiveness, it seems to run a lot smoother if you used all those funds for strictly payroll. It seems to be, and you had no net decrease, because that's part of the equation too on the forgiveness. If you decreased full-time equivalents, then it might only be partially forgiven, but it seems to run smoother if you're not paying for other costs, the 60% for payroll, and then you've got utilities, rent, mortgage interest. I mean, if it's strictly used for payroll, it seems to be a lot quicker and smoother. You have to provide them less documents, essentially payroll records.
I heard that as part of the legislation pending that there's a blanket forgiveness. PPP under 150 would all be forgiven. Should we hold off on our application for forgiveness if we are under 150,000?
I would say that it's going to be a lot easier. You don't have to supply all the documentation. You still have to certify that you spent the money properly, but the documentation, you have to save the documentation, but you don't have to send it in.
Yeah, and something else we didn't touch on, and I think it was published in the newspaper. If you got more than 2 million in PPP funds and want to get that forgiven, it's subject to lots of stringent requirements. Certifications, cash flow, liquidity. And the Department of Justice is starting to send out letters to those recipients. So you got to really look close at that. If you got more than 2 million in funds, some people are deciding, hey, I'm just going to repay the loan. I'm going to repay the loan. If there's an issue with showing liquidity didn't improve. It's just subject to a lot more scrutiny. So that's just a forewarning on big PPP loan recipients.
Is there any chance that travel expenses for union employees that travel out of state for work will be deductible sometime in the near future?
For federal purposes, that falls under miscellaneous itemized deductions, and employee, which were eliminated. In the current law and as it currently stands, those miscellaneous itemized deductions are no longer allowed. Still allowed for California, though. That's one thing we always tell our clients oftentimes, well, I don't need to provide you that information or those documents any longer because it's no longer allowed. It's like, well, it still is allowed for California. So please still provide that information because you still at least might get a California benefit. But as it currently stands, with the tax law that's currently now, those type of expenses are still not deductible.
Have any borrowers that you know of received a forgiveness decision from the SBA?
Yes.
Yes.
Yeah, I think I've heard of about 4 or 5 also.
Yeah.
So that is they're starting to trickle in, and a little follow up on our Kern Recovers loan forgiveness. The bank has approved the Kern Recovers loan for the museum. However, we have not heard back from the county as to the forgiveness. So that's an area that we'll dive into for next week's webinar, and that is our last question. And so I get to thank now both Lou and Patrick and all of our many sponsors also that are part of these webinars each week. I saved this toward the end this week to make sure we got through all of our questions. And next week, we're going to be back. I'll be back with Keith Bryce, and we'll be back here on December 23rd, the eve of Christmas Eve, webinar special. It's going to be fun. We're going to talk about a lot of really interesting topics that are tying to PPP and some of the new things that are going on in this year and next year. We didn't even get into the SBA loans and the tax aspects of if you have an SBA loan that was forgiven that I'm sure we'll dive into next week. So that's it for today. Patrick, Lou, it's great to have you on. Thanks. Anybody else, if you have any other questions, you can forward them through me, and I will get them to Lou and Patrick. We'll have plenty of resources coming your way in a couple of days, including this webinar. So for Lou and Patrick, I'm Kelly Bearden. We're out this weekend. We'll see you next week. Bye-bye now.
Thank you for the opportunity.
Bye. Thank you.